Welcome back to Bonds in a Blink. The first part of the year has been more difficult for bond investors than many expected. The key reason has not been credit deterioration nor a sudden collapse in growth expectations. It has been rates. More specifically, it has been a sharp repricing of monetary policy expectations. Let's start with this chart. As you can see, we're looking at the 3 months future rates for December 2026 expiry. This gives us a useful snapshot of where markets expect policy rates to be further down the line. What stands out is the sudden jump in rate expectations. This move began around the start of the conflict involving Iran, when markets started to price a higher risk of inflationary pressure, especially through energy and shipping channels. But the more interesting point is what happened afterwards. Even when equity markets began to price an improvement in the situation around the Strait of Hormuz, rates did not come back down. Equities recovered quite quickly, helped by the perception that the geopolitical shock might be contained. But fixed income did not receive the same relief. Rate expectations stayed elevated. In these two charts, you can see how much the rate outlook has changed since the end of January, and the difference is striking. In Europe, at the end of January, the market was still expecting a relatively benign monetary policy path. The idea was that any tightening, if it came at all, would likely be modest and would probably begin only in 2027. Today, the picture is very different. Markets are now pricing a much more aggressive tightening cycle and one that starts almost immediately. There is a major shift in a very short period of time. Situation in the United States, if anything, is even more surprising. At the start of the year, the market was still expecting the easing cycle to continue. Investors were looking for further rate cuts from the new Federal Reserve chair. Now those expectations have almost disappeared. The market has now moved from expecting continued easing to expecting no cuts at all, and in some scenarios, even the possibility of a renewed tightening. The question then is whether this repricing is fully justified by data. And this is where the third chart becomes important. Here we look at economic surprise indices, especially in Europe. These indices measure whether economic data is coming in above or below expectations. Recently, the European data has clearly deteriorated. The surprise indices have moved much lower, showing that the economy is disappointing relative to what analysts had built into their forecasts. We understand why financial markets are anticipating an ECB tightening, but we are wondering whether the economy will be able to absorb that many consecutive interest rate hikes. Let's go back to the underperformance of bonds. This underperformance becomes very clear when we compare bonds with equity markets. Equities have staged a stronger comeback after the initial shock linked to the Iran conflict. Bonds, however, have barely recovered. They remain under pressure because the rate component has not reversed. This creates a divergence. Equities are behaving as if the geopolitical shock has faded. Bonds are behaving as if inflation and monetary policy consequences are still very much alive. For investors, this divergence is important, and it also creates an opportunity. If rate expectations have moved too far, especially in Europe, then duration now looks more attractive than it did a few months ago. Yields have adjusted, valuations are better, and the economic data doesn't seem consistent with the full degree of tightening now priced by the market. Let's summarize our investment conclusions for the month. First, European duration risk is now more attractive. We're not saying the rate volatility is over, it's not. But after the repricing we've seen, the risk-reward in European duration has improved. If growth data continues to disappoint, the market may eventually need to reconsider how much tightening it is pricing. Second, we reiterate our cautious stance on a high yield. Spreads are not offering enough compensation in our view, especially given the macro uncertainty and the possibility that tighter financial conditions could eventually weigh on weaker balance sheets. We prefer not to chase yield in the lower quality part of the market at this stage. Third, we maintain our preference for financial debt. Within credit, financials continue to offer relative value. We particularly like subordinated bonds, where we believe spread still compensate investors for the risk. We also continue to see opportunity in BDCs, which remain one of our preferred trades. Thank you for listening and see you soon with Bonds in a Blink.